Welcome to the Deep Dive. We take the information you're curious about, sift through it, and pull out the key insights. Think of it as your shortcut to getting up to speed.
Yeah, exactly. And today, we're looking into Ethos Ltd.
That's right, their financial pulse specifically. One of you sent over a whole batch of documents on their results.
Covering the quarter and the full financial year that just ended March 31st, 2025. A pretty comprehensive set.
Okay, let's unpack this then. So we've got the official board meeting outcome notice,
Yep.
the audited financials, both standalone and consolidated,
It's full works.
slides from their earnings call, and interestingly, a report from Cressol.
Ah, yes, the monitoring agency report.
Yeah.
That one looks at how they've been using the funds they raised from their QIP.
The qualified institutional placement, right?
Exactly. So our mission here is pretty clear. Cut through the noise, move past just the raw numbers.
And give you, the listener, a solid grasp of Ethos's financial health and where they seem to be heading strategically.
We'll pull out what really matters from all these reports.
Great. So let's dive right in. The big picture first, FY25, the full year ending March 2025. What were the main takeaways?
Well, the full year definitely shows a company in serious growth mode. Revenue from operations. That hit 1,251.6 crore.
Wow. Okay. And how does that compare?
That's a 25.3% jump compared to the previous year, so quite substantial.
And other key metrics like profitability.
Their EBITDA, that's earnings before interest, taxes, depreciation, and amortization, also saw a really strong rise, up 22.3% year-on-year, landing at 214.4 crore.
Okay.
And their bottom line, the profit after tax, or PAT, that grew by a healthy 15.6% to 96.3 crore.
Those are definitely strong growth figures, impressive top line and bottom line increases. But I did spot something on the margins. EBITDA grew, yes, but the margin itself dipped slightly.
Ah, good catch. That's a very insightful point. While the absolute profit numbers are up, the EBITDA margin did tighten a bit.
How much?
It went from 17.1% in FY24 down to 16.8% in FY25. Not a huge drop, but noticeable.
So what's behind that? Usually you want margins expanding with revenue.
Right. Well, the company points directly to investments they're making, specifically hiring more talent and the costs associated with setting up their significant number of new stores.
Infrastructure costs, essentially.
Exactly. It seems like a strategic choice push for market share and expansion now, even if it puts a little temporary pressure on the margins. It's pretty common in a growth phase.
But it does mean those new stores need to start pulling their weight profit-wise sooner rather than later.
Precisely. That's the trade-off.
Okay, that makes sense. Investing for future growth. Now let's zoom in a bit. What about just the last quarter, Q4 of FY25? Did it follow the same pattern?
Q4 largely continued that growth story, yeah, but maybe with slightly different nuances. Revenue was up 23.3% year-on-year, reaching 311.3 crore.
Still strong growth then.
Definitely. EBITDA also grew by 20.7% to 53.6 crore. But the profit after tax growth was a bit slower in Q4.
Oh, how much slower?
It rose 8.1% year-on-year to 22.7 crore. Still positive, but, not quite the 15.6% we saw for the full year.
So maybe those investment costs we talked about were felt a bit more acutely in that final quarter.
That seems likely, yes. Or potentially some seasonality, maybe other market factors playing in during those last 3 months.
Okay, so consistent growth overall, but maybe a bit more margin pressure towards the year end. Now, moving beyond just the financials, what about their physical operations? How's the expansion drive looking?
Oh, they've been quite busy on that front.
Yeah.
Throughout FY25, they added 14 new boutiques.
14. Wow.
Yeah, bringing their total store count to 73 across 26 cities as of early May 2025.
And are they just adding stores in existing cities or branching out?
Both, actually. What's interesting is they've entered 3 completely new markets: Dehradun, Kochi, and Mangaluru.
Expanding their geographic reach significantly then.
Absolutely. It shows an ambition to tap into different regional customer bases. Plus, they opened a second duty-free store, this one at Bengaluru Airport.
Capitalizing on that travel retail segment.
High footfall, international travelers. Makes sense.
And it sounds like they're not stopping there. I thought I saw something about plans for this month, May 2025.
You did. They're planning to open another 8 boutiques just in May.
8 more. They're really accelerating.
Seems like it. And one highlight they mentioned is their first exclusive Masika jewelry boutique. That's going up in Delhi.
Interesting. So branching into exclusive brand stores too, not just multi-brand Ethos ones.
Yeah, it signals a move to cater maybe more deeply to specific luxury niches.
It sounds like a lot of new stores, but are the existing ones performing well? That same store growth figure, the SSG, looked quite
It
positive.
really did. Their SSG for the full year FY25 came in at 17.4%.
And how does that compare to the year before?
It's actually an improvement. FY24 was 16.0%. So seeing that accelerate to over 17% is frankly pretty impressive in retail.
Especially luxury retail, you'd think.
Definitely. It means it's not just new stores driving growth. People are spending more in their established locations too. Suggests good customer loyalty, effective strategies.
What else stood out operationally?
Well, their certified pre-owned, the CPO watch business, saw billings jump by 32.3% year on year,
That's a huge jump. So, strong demand for pre-owned luxury, too.
clearly. And another key metric, the average selling price, or ASP.
Ah, yes, the average price of the watches they're selling. Did that go up?
It did, up by 7.3% to 2.04 lakh per watch in FY25.
So, not only are they selling more watches in existing stores and opening new ones, but customers are also buying, on average, more expensive watches.
That's the picture, yes.
Mhm.
It's like customers are upgrading, choosing higher-end models more often.
Which all adds up. What was the total billing figure then?
Total billings for FY25 reached 1,456.6 crore. That's a 25.2% growth year on year, very close to the revenue growth figure.
Makes sense.
And one other thing to highlight digital's role. Their digitally assisted sales grew by a huge 37.2% to reach 492.0 crore.
So, nearly ₹500 million in sales had some kind of digital touch point. That's significant.
It really shows how important their online presence and digital tools are becoming, even in luxury where the physical experience matters.
Okay, let's circle back quickly to those EBITDA margins. We mentioned new store costs and talent. Anything else specifically called out?
Yes, the filings do explicitly mention increased employee costs as a factor.
Hiring more staff? Perhaps higher wages for skilled people?
Likely a combination of both. You need skilled salespeople, technicians, managers to support that bigger network and maintain luxury service levels.
And the rent on all those new places?
Exactly. Rental expenses for new stores hit the P&L before those stores reach peak sales. It's just the reality of retail expansion. It takes time for them to mature.
Got it. Okay, let's shift gears slightly. Financial stability. What's the balance sheet telling us as of March 31st, 2025?
Well, on the consolidated balance sheet, their total equity looks pretty solid at 982.2 crore. That reflects their growth and retained earnings.
And on the asset side, any big changes?
Oh, yes. A really noticeable jump in non-current assets. They went from about 6.6 crore in March 24 up to 519.1 crore in March 25.
Wow, quite an increase. What's driving that?
Mostly two things: property, plant, and equipment. So the physical stores, fixtures, that kind of thing.
Makes sense with the expansion.
And also right-of-use assets. This is mainly about how leases are accounted for now. It reflects their right to use all those leased store locations over the lease term.
Ah, so it directly ties back to opening all those new boutiques.
Precisely. The big jump there is a clear financial reflection of their aggressive store opening strategy.
What about current assets? Things like inventory.
Current assets were also substantial, around 890.5 crore. And yes, inventory, mostly luxury watches, made up a big chunk of that at 592.7 crore.
Lots of watches on the shelves, ready to sell. And liabilities.
Total liabilities were listed at 427.4 crore. Seems quite manageable when you look at their total assets and equity base.
Definitely sounds like they have the financial footing to back these expansion plans. Now, Ethos often talks about its focus on luxury customers. What did the documents say about that?
They definitely highlight building that large base of luxury clients, through the shopping experience they offer, the brands they carry.
And they see a link to the number of wealthy individuals.
Yes, they explicitly mention a direct correlation between demand for their high-end stuff and the number of high net worth individuals, or H&Is, in their markets.
Which makes intuitive sense.
It does. And importantly, the share of their sales coming from luxury and high luxury watches keeps increasing. It hit 70% in FY25.
70%. So they're increasingly focused on the very top end.
Seems so. And that ties right back into that rising average selling price we discussed earlier. It reinforces that strategic focus.
You mentioned 14 stores opened in the year. Can we get a bit more granular on where and when?
Sure. The documents break it down by quarter. So in Q4, the last quarter, just one new boutique opened in Ludhiana.
Okay.
Q3 was much busier, 5 openings. 3 were in Bengaluru's Mall of Asia, standalone boutiques for Bell & Ross, IWC, and QLOC KT2O.
Interesting, dedicated brand stores again.
Yeah. Plus a Summit multi-brand store in Delhi's Tagore Garden, and a second Ethos multi-brand in Kolkata's South City Mall.
Quite a mix. What about Q2?
Q2 also saw 5 new ones. Again, Bengaluru's Mall of Asia was a focus, with a Summit, a Breitling, and a Hublot boutique opening there.
That mall seems like a key location for them.
Definitely. They also opened a Summit in Mangaluru that quarter and another Summit at Bengaluru's T2 International Airport.
And Q1, the start of the financial year.
Q1 had 3 openings. Summit boutiques in the new markets of Kochi and Dehradun, and an Ethos multi-brand store in Pune.
Thanks. That paints a much clearer picture of the rollout. A real mix of existing strongholds like Bengaluru and Delhi, plus pushing into those new Tier 2 cities.
Exactly. It seems quite strategic geographically.
And it wasn't just about opening stores, right? They also brought in some new watch brands during the year.
Yes, they added 6 new brands to their portfolio in FY25, some quite interesting ones.
Oh, like who?
Okay, so there's Christian Vanderklau, a Dutch brand, really known for complex astronomical watches.
High-end niche stuff.
Very much so. Then Karl Suchi and Sohn, a historic Austrian brand, more about elegant, minimalist designs.
Okay.
They also added Zero Halliburton. That's the American brand famous for those sturdy aluminum suitcases.
Luggage. That's a bit different.
Yeah, a complimentary luxury item, perhaps broadening the offering.
Mm.
Then back to watches. Hotlens, a Swiss brand known for really avant-garde designs and how they display time.
Creative watchmaking.
Definitely.
Yeah.
Then ID Genevieve, which focuses on luxury watches using sustainable materials and ethical production.
A nod to sustainability. Interesting.
And finally, Singer Reimagined. They've won awards for their innovative chronographs, kind of rethinking classic designs.
Quite a diverse group of additions. Seems like they're aiming to cover more bases within luxury.
That's how it looks, yes. Diversifying the portfolio, appealing to different tastes within that high-end segment.
Okay, one last major area, that QIP funding. They raised a significant amount. How's the deployment of that capital going?
Right, the qualified institutional placement. They raised 17,499.82 lakh gross, which netted down to 16,959.64 lakh after expenses.
A substantial injection of capital.
Indeed. And CRISIL, the monitoring agency, gave their report for the quarter ending March 31st, 2025. Their verdict? They confirmed the money is being used as intended, according to the offer document.
Good to hear. So where has it gone specifically?
Well, the largest chunk so far, 8,455.97 lakh, has gone towards working capital needs. That was out of a total planned allocation of 13,125 lakh for working capital.
Okay, supporting day-to-day operations, inventory, etc. What about other uses, general corporate purposes?
Interestingly, during this specific quarter, Q4, there was no money drawn down for general corporate purposes, or GCP. So the full 3,834.64 lakh allocated for GCP in the plan remains untouched for now.
And the total unutilized amount from the QIP, where is that sitting?
The total unutilized proceeds stand at 8,503.67 lakh. They've temporarily parked most of it in fixed deposits with HDFC Bank, earning some interest. And a portion is in a current account with Kotak Bank, likely for easier access for upcoming needs.
Was there any mention of delays or changes in the utilization plan?
Yes, there was a specific note about a delay. About 2,000 lakh that was earmarked under GCP, specifically intended for buying inventory for new stores in the Delhi NCR region.
Okay.
That didn't get spent as quickly as planned due to some procurement delays. They expect to use those funds in the next quarter, though.
So a timing issue rather than a change of plan.
Seems so. And conversely, they actually noted an acceleration in using funds for working capital.
Because business is growing faster, needing more operational cash.
That's the implication. Increased operational demands from the rapid expansion and strong sales growth necessitated using that working capital portion a bit quicker than originally projected.
Okay, so let's try and wrap this all up then. Our deep dive into Ethos Ltd's recent performance. It really shows a year marked by, well, significant growth, wouldn't you say? Revenue, EBITDA, both up strongly.
Absolutely. Fueled by that aggressive store expansion strategy, adding new locations, entering new cities, and also bringing in those interesting new luxury brands.
And we see they're actively using the capital from the QIP, mainly bolstering working capital to support all that activity.
We did also flag that slight compression to the EBITDA margins.
Right, attributed to those necessary investments in stores and people. That's definitely something for you, the listener, to keep an eye on in their future results.
But balancing that, you have the really robust same-store growth over 17% and that steadily increasing average selling price.
Yeah, those feel like very positive signs about the underlying health of the business and the strong demand for what they offer.
Definitely strong indicators.
Yeah.
Which actually brings us to a final thought for you to consider.
Okay.
Given this ambitious push into new regions and bringing in such a diverse range of new luxury brands,
Yeah.
how might this wider portfolio and broader geographical footprint position Ethos for, continued or maybe even accelerated growth in the next fiscal year?
Good question.
And specifically think about that interplay. They're investing heavily in physical stores, but we also saw that huge jump in digitally assisted sales. How will those two sides, the physical and the digital, work together? How will they synergize to shape Ethos's future in this very competitive luxury market? Something to mull over.